So my boy Dave Ramsey hit us with a big one on Instagram as of yesterday. Dave Ramsey came out with an Instagram post talking about what you should invest in and what you shouldn't invest in, and well, it ruffled some feathers in the finance space. Now, in today's video, guys, I am not here to bash on Dave Ramsey. Dave is one of the main reasons why I found the passion that I do have now for personal finance and also for helping people, viewers like yourself, with their financial status and becoming better financially. But I will say this, with the amount of knowledge I've gained over the years in the personal finance space and investing space, after reading this post from Dave Ramsey, I was a little shocked. So Dave Ramsey made this Instagram post the other day, and I'll have it right here so you guys can read along. It says, how to invest your money. Invest in mutual funds spread equally in 4 categories: growth, growth and income, aggressive growth, and international, and then real estate that is paid for in full, meaning you're using cash to make that purchase. And then he says, do not invest in single stocks, Bitcoin, or any cryptocurrency, whole life insurance policies, annuities, bonds, micro investing, REITs, ETFs, and CDs. So I want to break this down line item by line item for what it's worth. I want to give my points on my opinion, but I thought this was pretty crazy to see this and to have Dave Ramsey, somebody that I look up to, post and have some of these things listed for him not to invest in. So the first thing I want to jump into is the investing in portion, and he says mutual funds. Now he says to spread them in 4 different categories, which I like that because it's diversifying a little bit and you're getting into different sectors. You're getting a little bit of growth, aggressive growth, income, and international. Now, with that, why wouldn't he say just to come out and invest in index funds that track an index like the S&P 500? That is one thing that really I never agreed with Dave in his advice. So quickly, why would you want to invest in an index fund versus a mutual fund? So a quick difference between the two here is the mutual fund is an actively managed account, meaning you have a team that manages this fund. An index fund is a passively managed account, meaning this fund basically tracks an index like the S&P 500. The S&P 500 is made up of 500 different stocks, so if you go buy an ETF like VOO, that's going to be investing in the same stocks that are in the S&P 500, meaning that it tracks that index. So when you have a team that manages that mutual fund and is consistently buying and selling stocks to try and outperform the market or that S&P 500 index, you have to pay for that service. So mutual funds tend to be a lot more expensive. You can see expense ratios up above 1%. Over a long period of time, and as your account grows, that 1% can eat up a lot of your profits. So when you go with an index fund that's passively managed, those are typically going to have very low expense ratios and not eat up those profits on something like a mutual fund would. Like I said, with mutual funds, you can see expense ratios from 0.5%, 1%, 2%, and even higher. And then something like index funds, you're going to see expense ratios that are completely free. I know Fidelity has some of those that they offer. And then also you'll see them at the range of 0.04 to maybe 0.1%. Now you may be sitting there thinking like, oh, well, I would like to be able to outperform the market and earn more money on the money I'm investing. But when you think about it and you actually sit down and look at what mutual funds and how they perform on a long-term basis, yes, there are hedge fund managers out there who can outbeat the market, this year, and then they may underperform the following year, but then they outbeat it the next year. There's a statement here that I want to read for you guys, and it's following the stats. It says, for the 9th consecutive year, the majority of large cap funds lagged the S&P 500 last year. And then after 10 years, 85% of large cap funds underperformed the S&P 500. And after 15 years, nearly 92% are trailing the index. Guys, think about that for a second. The longer you hold mutual funds, right? That's a less of a chance you're going to outperform the market. So why would you not just take the guaranteed return of knowing you're going to get that whatever the market performs with an index fund? All while not having to pay for the fee and the service to do that. You're paying for a service that has a literally 8% chance of outperforming the stock market on a long-term basis of 15 years or more. That is mind-blowing, and that blows my mind that Dave Ramsey wants to advise his followers on doing something and investing their hard-earned money in something like that when they would be much better off investing in an ETF or an index fund that tracks the market. Now, when it comes to his mutual fund advice, and one of the reasons why Dave may be doing this, and I'm not saying he is doing it for this reason, but these kind of connect the dots here a little bit. Dave Ramsey has a feature on his website and that he gives to his listeners, and it's called the SmartVestor Pro. And basically what this is he links you up with personal finance or financial advisors that are within your area or in your state. Now, if Dave Ramsey gave the financial advice like most people I feel like in this space do, and they say to go buy an index fund that tracks the market and you don't have to worry about a thing, well then what that does is that defeats the purpose of having a financial advisor and using the SmartVestor Pro. Now I'm not saying this is why Dave gives this advice, it's just something that looks a little odd when you look at why he is giving the advice he is giving. When you look at somebody who could go buy an index fund, but then instead send them to a financial advisor where they're going to have a chance of having and buying in a mutual fund that's going to outperform the market, when we look at the stats, most of them don't. That entices that follower or listener to use the SmartVestor Pro feature and go hire a financial advisor, which again, I don't think many people need. If he would just teach the setup process to buy an index fund, have that money come out of withdrawal from your account every single month on a monthly basis and never look at it again, majority of those listeners will be much better off than having to pay the fees they pay their financial advisor to do pretty much the exact same thing for them. Now moving on to the next one, it says real estate paid in full. I actually love this advice. Yes. Can you go leverage your money and can you go buy rental properties and real estate on borrowed money? Absolutely. I do it myself personally because I believe real estate is one of the best wealth building tools out there because you can leverage your money to do that. Now, I understand where Dave comes from here. He says you need to be buying real estate, you're these extra properties and rental properties with no mortgage and have cash. But let's be honest, guys. It's 2021. Look at the real estate prices and where we're at. I also know there are safe ways of borrowing money and not getting too over leveraged. Like myself, I've told my wife I'm never going to be purchasing rental properties that I cannot cover all of the mortgage payments myself. In case we had some economic meltdown and no one was going to pay me rent, I would not want to foreclose on those properties. Now again, is that maybe way more conservative than most real estate investors out there? Probably, yes, but it's what makes me sleep better at night, and it's what I would like to see other people do so they don't get caught up when we see the next 08, 09 real estate crash. So again, I understand where Dave comes from in this sense of buying real estate in full, but to be honest, it's really just never going to happen for most people. If you do want to build wealth, you do have to take the risk and leverage your money into buy real estate. It's just up to you to make sure you're finding those good deals and being able to have that monthly cash flow cover your expenses and also put a decent amount of change in your pocket every single month for whenever you do have vacancies or repairs that come up. All stuff I talk about here on my YouTube channel. So click that subscribe button if you haven't already. Now moving right into the do not invest in. I'm going to try and keep these short, but he says the first one here is single stocks. Totally understand where he is coming from on here. I would probably recommend most people are going to be better off if you just buy that index fund. Because when you're buying single stocks, what you're doing is you're trying to outperform the market. You are telling yourself as an investor when you buy single stocks is you think I can beat the market with the stock picks that I'm making instead of just putting all my hard-earned money for that guaranteed return, whatever the stock market's going to give me for that year. Now, for me personally, I think people can invest in single stocks and I think it's a good hedge. Do I think majority of people probably need to have a majority of their money in index funds or ETFs? Yes, I do believe that. But I personally don't think that there is anything wrong in owning single stocks if you think the stocks you're purchasing are going to outperform the market over the long term. Now, the next line item on here is Bitcoin or any cryptocurrency for that matter. Now, I got to say this when we're talking about cryptocurrency, Bitcoin is the best performing asset that we've had over the past 10 years. That's outbidding the stock market, real estate, gold, any other asset class you look out there. Now, although I do not agree with Dave on that, you should not be investing in cryptocurrency at all, I do think that crypto is still considered a pretty speculative investment and it deserves a smaller percentage of your overall net worth. I do own cryptocurrency and I believe in the future of cryptocurrency, but I also believe we are in the early stages and still set to have some major volatility over the years. So I believe it's better off for me to have a smaller overall percentage of my net worth in cryptocurrency or Bitcoin. Now, I'm not saying you need to go do that. That is just my beliefs and what I'm doing. Now, these next two here, whole life insurance policies and annuities, I agree with Dave on these. I don't think anyone should be investing in whole life policies or annuities for that matter. So we'll skip through those two real quick. Bonds, I do think bonds has a good spot in portfolios for the certain time of life you're in. I personally don't own any bonds myself, but I know as I get closer to retirement, I will probably have some sort of percentage of my portfolio in bonds just for the overall safety of my portfolios. Now, the next one you list here is micro investing, and that's simply something like using a tool such as Acorns, where it takes a certain amount of change or whatever you have left over and it goes invest that in an ETF for you. Now, when it comes to micro investing, I don't think this is necessarily a bad thing to do by any means, but I do think if this is your only form of investing, you probably need to be looking at putting in a little bit more money to set yourself up down the road for retirement. Now, here's the big one, guys. This is the one that I had my jaw jaw dropped. REITs, ETFs, and CDs. CDs, I'm okay. I agree. I agree with that point. We don't need to be investing in CDs with the rates we're getting right now. REITs, again, that kind of goes with the single stocks, what I talked about that in. But the big one here is ETFs. And if you guys watch this video to here first, thank you. If you got value, could you please hit the like button? But whenever he said ETFs in this post, again, my jaw dropped to the floor. I believe personally that ETFs and index funds is probably the single-handed greatest investment anyone could ever do. When anyone asked for me about JJ, which stock should I be buying, or what should I be doing with this, most of the time I will just tell everyone, start off by investing in a good quality index fund. VTSAX, VTI, VOO, index funds and ETFs are basically the best investments that you're going to get for your money. And it kind of goes back to what I was saying earlier about it tracks the market. You're guaranteed that market return for whatever the stock market's going to do for that year. So when Dave says you should not be investing in ETFs, I honestly don't see the point in the reasoning for him saying this, unless we go back to that SmartVestor Pro portion I was talking about, of where he may lose some business for sending his listeners to the financial advisors that uses that platform and that pays to be on that platform. So again, like I said, I think Dave Ramsey has been a huge influential person in my life, especially on my financial journey. I do believe that when it comes to paying off debt and becoming better financially, if you're new to the game, Dave Ramsey is a great source to use and to mimic off of. But when it comes to investing in that next step further of trying to retire and get yourself set up financially, I do think there may be better routes to go instead of Dave Ramsey's advice of only investing in mutual funds and buying real estate full in cash. I still am in disbelief that Dave Ramsey says not to invest in ETFs or index funds. I actually do remember him seeing a video where he says he doesn't mind ETFs in the video, and so that kind of was a little confusing to me as well, as to where he would tell his followers and listeners not to invest in ETFs, but then he says on his show that he's okay with index funds and ETFs. He just would rather buy mutual funds. It just doesn't really make sense to why you would tell someone not to invest in one of the greatest investment vehicles that's been created for man to this day and age. So I've blabbered on long enough about this video, but I really wanted to get this out to you guys because I think this is important to understand. I want to hear y'all's thoughts on this down below. Do you 100% agree with Dave Ramsey? Or do you think that this advice he came out with this post is maybe not the best advice at all? Let me know down in the comment section your guys' thoughts, and I'll be down there trying to answer some of your comments and responding back as well. Again, if you guys are new here, thank you so much for watching. I talk everything personal finance related, so if you are interested in that, make sure you click that subscribe button down below. Guys, thank you all so much for watching. Again, let me know your thoughts in the comment sections, and until the next video, you all take care.